You're out shopping for a home and you come across a seller. Could be a new construction seller, could be a traditional resale seller, but they're willing to negotiate on the price of the home. And let's just call it a $40,000 swing here on price. But they say, hey, you can use that as a price reduction, or you could do a little bit of a price reduction and use a seller credit towards your closing costs, which is going to help you buy that interest rate down, or you could take the full $40,000 and just use it for a interest rate buy down to really keep your payment down or reduce your cash to close. So this is like a cool place to be in, but what do you do? How do you know what's best for you? Well, take a peek at this financing strategy. I'm going to walk you through each one of those, and I think you're going to be enlightened to see the real difference in the payment. For now, I'm not applying the $40,000 towards the funds to close in any of these scenarios because I really wanted to keep it apples to apples. So let's assume, and this is a real life scenario on a new build that one of our clients was looking at. So it was a $675,000 purchase price. The builder was offering this $40,000 flex incentive, which means they could use it however that they wanted to use it. So they could use it to drop the price, which is what we see in scenario one. So we're going to take it from a $675,000 purchase price. We're going to drop it to $635,000 purchase price. But in that scenario, there's no interest rate reduction. There's no monies that are allocated towards reducing that interest rate. So let's just call it current interest rate, current terms. We're using 6.125% as an average. And then that's going to bring the total PITI payment with 10% down, so this includes mortgage insurance as well, at $39.42. Okay, lock that in. Now we're going to go, hey, what if I wanted to take 20 of that 40 and reduce the price, and then use the other 20,000 to help me buy down the interest rate? Okay, well, we can show that. So scenario two, we're going to drop that price by $20,000 to $655,000. Then we're still doing 10% down in this scenario. Rate now is going to drop from kind of that 6.125 to low fives. Check this out, 30-year fixed rate, 5.375% to get to use up that $20,000 that's being allocated for a rate buy down. That's going to drop the payment to $37.71. So those two scenarios alone, without the third one, is only changing the payment $172 a month. What? Right? So again, I think like these numbers are so big and people are like, oh, naturally it's going to save so much. The numbers don't show that. So let's look at column three. Column three, we go back to now the full $675 purchase price with the full $40,000 being used for a rate buy down. That rate goes to 4.75% on a 30-year fixed rate, with the seller paying that credit to pay for the full amount. Now the payment goes to $36.39 per month. Again, a $300 savings based on or compared to that original $675 purchase price with 40 grand down at current market rate. So what do? I don't think there's an easy answer here. What you do is based on what is best for you. And this is the real piece of the puzzle. It may make more sense for you to take the price reduction, pay the higher rate if that payment is comfortable for you, and bet on rates reducing in the future that you could potentially refinance and drop that rate even further. But what if rates don't drop further? Are you still comfortable at that payment of $39.42, knowing that you got $40,000 off the purchase price? If so, awesome. Then that's the best strategy for you. But if you're in a situation where you're really trying to push that price point and you maybe can't qualify without that rate buy down strategy or to save that $300 a month, then the third scenario could make more sense for you. So I think it's one of these things that so often there's like a right strategy. No, what's the right strategy is what your objectives are and what your personal scenario is. And this translates over into the resale world too. So it's not just on new builds. This came up because it happened to be on a new build, but in the traditional resale environment, depending on the area across the country, and as a reminder, we lend all across the country, we will see some sellers wanting to drop purchase price, and they're talking to their real estate agents who are reaching out to us and say, hey, can you prepare one of these so I can show my seller the net benefit? And in this situation, a traditional seller could offer the same thing. The seller could say, hey, interested buyer, we can reduce the price by X dollars, or we can allocate those funds for a rate buy down. What do you want? What's better for you? And I think just opening up that conversation is so helpful because it isn't always one path. Many times there are variables that come into the conversation together with your specific objectives and goals that is going to be the right answer for you. To schedule a 15-minute conversation with our team, just click below. We can get into the details, better understand what your goals are, and help give you guidance on the next steps to achieve home ownership and do it in a way that best suits you.